Hello, and welcome to Arnerich Massena's first quarter 2018 MarketCast. It was an unusually volatile quarter with fast-breaking news shaking up markets across the globe. Yet, after all was said and done, stock and bond markets on average were just slightly lower. To take you through some of the quarter's highlights, I'd like to introduce Senior Research Analyst Arthur Coyne.
Thanks, Brian. Worries about rising interest rates and rising import tariffs took their toll on capital markets during the first quarter. After starting strong, the S&P 500 reversed and closed lower, and U.S. bond prices also headed lower as yields rose across all maturities. And despite the higher yields, the U.S. dollar fell 3% on concerns over trade and budget imbalances and falling U.S. bond prices. This weakening U.S. dollar helped lift global bonds and emerging market stocks, but fears of rising tariffs hurt major international exporters such as Germany and Japan. During the quarter, yields rose across all maturities, driven by the strong economy and the Federal Reserve's shift to tighter monetary policy. As we can see, the Fed has been periodically raising the short-term Fed funds rate, but perhaps even more important, it's also been cutting back on its purchases of bonds of longer maturities, an important development. Here, we're looking at the years following the 2008 financial crisis, a time when, to restore market confidence and bring the economy back into equilibrium, the Federal Reserve bought trillions of dollars of bonds as part of its quantitative easing. We see this as the rising gray shaded area. In addition to stimulating the economy, this unprecedented bond buying seems to have also helped reduce the fear of market volatility, which we can see in the red and blue lines. But here's the twist. In 2017, with the economy back in shape, the Fed announced that it would begin reducing its bond holdings by not replacing some of the bonds as they mature. This reversal in direction, which started to take effect last fall, seems to already be making an impact, not just by driving interest rates higher, but also by raising the possibility that market volatility may start trending higher as the Fed shrinks its bond portfolio. Adding to the uncertainty, the Trump administration imposed a series of import tariffs during the first quarter, citing concerns of national security, unfair trade practices, and a worsening trade deficit. This triggered an immediate retaliation by China in the form of new tariffs on many American-produced goods. To put the new tariffs in context, we note that over the past century, as globalization has advanced, U.S. tariff rates have fallen dramatically to an overall effective rate of 1.4%. And while the tariffs introduced during the quarter were narrow in scope and unlikely to push the overall rate above 2%, the communications surrounding their announcement raised the possibility of additional tariffs to come, and this had a chilling effect on investors. Aware of the growing U.S. trade deficit, Treasury Secretary Mnuchin made a comment that seemed to favor a weaker U.S. dollar as a means to improve trade competitiveness. While the administration later backpedaled from this comment, it appeared to contribute to the dollar's 3% decline during the quarter, a move that tended to help the returns of non-U.S. investments. So here at home, are U.S. stocks expensive or cheap? The answer seems to depend on which stocks you're talking about. In this chart, we see that large-cap growth stocks have risen to price-to-book valuations that we haven't seen since the tech bubble almost 20 years ago, while large-cap value stocks are still trading near their long-term average. When we look across regions, we see U.S. stock valuations currently appear to be a good deal higher than international, emerging, and frontier stocks. For example, since 2012, U.S. stock prices have been rising faster than their earnings, causing their price-earnings ratio to trend higher. But among international developed countries, the trend has lately been the opposite. International earnings have been rising faster than stock prices for the past 2 years, causing the international PE ratio to move a lot lower. Meanwhile, the valuation trend for emerging and frontier markets has been relatively muted during this period. Given the current environment, our tactical views haven't changed. We continue to like the growth and valuation prospects of international stocks, and we still favor overweighting international equities versus the global benchmark. We're also finding value stocks more attractive. Our view is to overweight value stocks versus growth stocks. And with short-term interest rates having risen and credit spreads still narrow, we believe in maintaining a lower duration and limiting credit exposure within fixed income investments. Your advisor will keep you informed as investment opportunities become available. For more information, visit us on the web at arnerichmassena.com. Thank you for joining us.